in history. You've got high interest rates, you've got a strong dollar, and a reasonably strong economy, and a strong stock market. That's not an environment where gold should do well. So we all know that, but I think it's important, in answer to your question, it's important to really, put that front and foremost. So the reason gold went up over the last 18 months was not because the macroeconomic environment was favorable. It was not because investors were flooding into gold. It was because, number one, central banks were buying gold, as we know, consistently. And number two, Chinese savers, Chinese investors, Chinese savers, starting at the beginning of this year, started pouring into gold.
Gold prices have surged by 15.52% year to date, making it one of the top-performing commodities in the market. The precious metal has consistently printed new highs monthly and has shown sustained growth in various indices. This year, retail investors, institutional funds, and central banks from developing countries have taken significant positions in gold. AdrianDay of AdrianDay Asset Management highlights that despite traditionally unfavorable factors such as high interest rates, a strong dollar, and a robust economy, gold prices have risen significantly over the past 18 months. This unexpected increase is mainly due to substantial purchases by central banks and increased investment from Chinese savers beginning earlier this year. Most traders who invested in gold at the start of the year are now in profit, with gold reaching an all-time high of $2,450 this month. However, profit-taking by institutional funds has recently led to a slight decline, with prices falling to around $2,340 this week. Interestingly, Day notes that gold stocks and silver have only started to rise in recent months. The influx of gold investors has been primarily limited to a few large, sophisticated entities, with the broader market of massive investors yet to enter this space significantly. Silver has also seen a remarkable performance, exceeding $30 per ounce. This surge triggered a wave of short selling in silver futures, reducing net long positions by 4,000 to 37,700 contracts. Despite the speculators' doubts, silver prices have held above the critical $30 per ounce level through the weekend and have outperformed gold again on Monday. Spot silver recently traded at $31.513 per ounce, up 3.92% for the session. Day also points out an interesting trend with the largest gold ETF, GLD, which has experienced more outflow days than inflow days over the last 3 months, despite the rising gold prices. This indicates a cautious approach among some investors, even as the market for precious metals shows significant strength. Join us as we delve into AdrianDay's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
This bull market so far has been really completely different from other bull markets. I mean, when you look at the last 18 months, up until the last couple of months, you've seen gold move steadily, consistently, and quite powerfully, but the gold stocks not move until the last few months, and silver not move until the last few months. And of course, the macroeconomic environment, if you just took a snapshot, don't look ahead, but just take a snapshot, you've got high interest rates that have come off the most rapid in terms of percentage, the most rapid rate hike in history. You've got high interest rates, you've got a strong dollar, and a reasonably strong economy, and a strong stock market. That's not an environment where gold should do well. So we all know that, but I think it's important, in answer to your question, it's important to really, put that front and foremost. So the reason gold went up over the last 18 months was not because the macroeconomic environment was favorable. It was not because investors were flooding into gold. It was because, number one, central banks were buying gold, as we know, consistently. And number two, Chinese savers, Chinese investors, starting at the beginning of this year, started pouring into gold. It's only really been the last couple of months, since the beginning of March, that investors of any type have started to move into gold. And primarily, it still is, a few, I'll say relatively few, very large and sophisticated investors, whether it's Middle Eastern, families, Asian families, or, large, smart investors in the US, like Michael Burry, from the Big Short, who's moved into gold, and people like Druckenmiller, who's moved into gold, Stanley Druckenmiller, who's moved into gold stocks. But the massive investors are still not in this market. So let's just give a couple of examples of that. If you look at the GLD, which is the largest gold ETF, for the last 3 months, even though gold has dramatically moved up, we are still seeing more days where there are outflows than where there are inflows. If you look at coins, which is a good reflection of the retail market, both in Europe and the US, all the coin dealers I talk to tell me they are continuing to get people calling to sell coins, not to buy. You look at the premiums on coins, you look at the deliveries from the mints, because you don't have hard numbers on coin sales, right? But you can look at the deliveries from the mint for new coins, you can look at the premiums. These are pretty good reflections of the demand for gold coins, and they are just not moving up. And most astonishingly of all, if you look at the GDX, which is the largest fund for gold miners, senior gold miners, again, even now with the gold stocks having moved up so much, you go back to April the 8th, and there have only been 2 days where Vanguard, the fund sponsor, has reported net inflows. I mean, it's just astonishing. And so what this means is that the massive investors, and I'm coming to your question, it means the massive investors are simply not in this market. And another anecdote, if I may, gold funds. We manage a fund, the Peter Schiff Euro Pacific Gold Fund. Other fund managers I talk to tell me they're getting as many outflows as they're getting inflows, even this year, even with gold doing what it's doing. And in Canada, people tell me they're getting consistent outflows pretty much every day.
The silver market continues to experience significant upward pressure, with the Monday session reflecting this trend. However, trading activity was somewhat subdued due to Memorial Day in the USA, resulting in lower liquidity. AdrianDay of AdrianDay Asset Management explains that while silver often mirrors the price movements of gold because of its role as a monetary metal, its substantial industrial demand and unique supply dynamics cause it to behave differently. Silver has shown impressive performance, with a 31% price gain overall and over 16% in the past month. This rally surpasses gold, which has increased by approximately 13.5% year-to-date and less than 1% in the past month. Day highlights that the absence of large stockpiles and the reliance on byproduct mining makes silver less responsive to price changes. This characteristic leads to sharper declines during bear markets and potentially more dramatic gains during bull markets. Let's get back to the interview.
Silver is an interesting metal because, of course, it is a monetary metal. There's no question about that. It's a monetary metal. And if you look at silver, whether it's over the last 100 years or even over the last 20 years, it tends to move, with gold, with the monetary factors, and it tends to move with gold. It can be more exaggerated. It can have shorter term moves. It can have higher spikes and lower lows, but it tends to move in the same broad direction as gold, which means it still acts very much as a monetary metal. So we know that, but I mean, I think it's just essential to say. On the other hand, of course, silver, is quite different from gold, and in a couple of fundamental ways. One fundamental way, of course, is the industrial demand, which can be a positive as well as a negative, but the industrial demand that really doesn't exist in any meaningful way for gold. And the other thing that's really different about silver from gold, and also compared with how silver was 40 or 50 years ago, is that on the production side, on the supply side, there are no huge stockpiles of silver hanging around in central bank vaults, or indeed anymore in people's attics with grandma's teapots. All the ones that were, a lot of those were sold in the 1970s, as you know. So there's no huge stockpiles of silver. The silver supplies are all in the hands of individual investors, and that's quite different from gold. And the other thing on the supply side that's completely different, and different from how it was 40 years ago, is that most silver production is byproduct. Probably as much as 80% of silver supply is byproduct. And the only pure silver mines that are left, there's very few up in Coeur d'Alene area now. There's very few in the Western United States. The only pure silver mines really are in Bolivia, Mexico, and Russia. So 80% of your supply is byproduct. What's that mean? Well, some of that byproduct is byproduct of a gold mine. So, okay, gold and silver move together, et cetera, but a lot of it is byproduct of base metals, whether it's a lead mine in Bolivia or a zinc mine in Peru. And the important thing about that is if you have a zinc mine in Peru, where 10% of your production revenue is from silver, you do not make decisions on the mine based on the price of silver. You make decisions based on the price of zinc. Same for the lead mine in Bolivia. And so what that means is that silver supply does not react very well, if at all, to changes in the price of silver. Whereas the gold price will react. Now, it takes time, of course, but if the price of gold, falls to 1,100, 1,000, 1,100, 1,900, then some mines will close, expansions will be put on hold, new projects won't come on. The old saying, the answer to low prices is low prices, because low prices restrict demand. It takes supply, it takes time. That dynamic doesn't exist in the silver market, right? The lead miner doesn't restrict his lead production because the price of silver goes down. And so that's one of the reasons, in 2014, 15, 16, silver fell percentage-wise a lot more than gold did because of that lack of response. But we're in a different situation now. So the good news is, but it can have an exaggerated move on the upside because you don't get a big increase in supply.
Silver has outperformed gold recently, with significant gains over the past month. Do you believe this trend will continue? And what factors might influence silver's performance relative to gold shortly? Could industrial demand play a more significant role in silver's price movements? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.